to walk us through today case. So everyone can see my screen, correct? Get a brief little thumbs up. Awesome. Okay. So today's lecture, I am very excited to walk you guys through. To give you a little bit of preface and context with this. So I'll introduce myself, but before I do, this case that I'll walk us through actually happened. So this is a real world case that I was faced with in the first 3 years out of my undergraduate degree at Northeastern. So I think this will be a good exercise to walk through analytical thinking. And this isn't going to be a detailed technical analysis. What I'm actually going to do is give you the information that I received. And I really want to focus on how people think about solving problems and the types of questions you're asking, right? Because there's no right or wrong. There are wrong and right answers, but there's no strict one right answer to any question, right? You can go about and solve the same question in maybe half a dozen or a dozen different ways. And the goal is not just to get your boss's thumbs up, but to make sure that you're finding that single source of truth and that you have a reasonable, airtight, objective conclusion that you can take that is supported by strong evidence in your analytical thinking. And as Maxwell mentioned, this is part 2 of my lecture series. And so the theme of this general lecture series is using imperfect and incomplete data, right? And so that's something we work with every day. So for today's analysis, what I'm going to walk us through in this case is what Maxwell had mentioned, using a forensic analysis. And by forensic, I strictly mean there's an accusation of a crime occurring, and you need to actually look through almost the footsteps and the breadcrumbs of what led to that crime happening to understand maybe what the person did wrong and what their motive was, and how to understand the best way to penalize them. And so we're using forensic analysis of stock market data to basically see whether or not a company was fraudulent, that a company behaved fraudulently. So I'll introduce myself first. My name's Pat. Pleasure to meet you all. And to give you a little bit of background about myself. So I studied at Northeastern. I got a BA in International Affairs and Economics. And I graduated. And from there, I did a little bit of work in the diplomatic sector for a number of years. I worked for the United Nations as a security analyst, and then eventually as an officer and a manager for their economic development division. So I was supporting work from the General Assembly, working with a bunch of different diplomats, business leaders, academics. And a lot of this began qualitatively. And then as I transitioned into the econ aspect of things, it became very heavily quantitative. So a lot of use of statistics, a lot of use of large data sets and big data, and running code to do anything from data cleaning and curation to running some basic analysis, which then ramped itself up throughout my career. So from the UN, I actually fell so much in love with economics. Surprising, I know. I still don't know why I went the econ path, but I did fall in love with it. And from there, I actually became a professional economist. So I held the title of economist. I worked in an economic consulting firm for about 4 or 5 years, 3 different firms, but over the course of 4 or 5 years. And the role of my role in those companies was basically, and this is what this case is from, was if you take a step back. So the reason Amazon is in a lot of control right now, but doesn't control everything, is because of the regulators, government bodies like the Department of Justice or the Federal Trade Commission actually will step in and prevent these companies from doing certain things that might give them too much power. And the process is never perfect. Obviously, Amazon is a little too powerful right now. They can charge pretty much whatever prices they want. People are heavily reliant on them, similar to Tesla. But in general, a lot of things could have gone very, very wrong in our economy if regulators had not stepped in. And so when those regulators step in and they try to prevent, say, 2 enormous companies from merging and creating a super company, or, a company from, committing some crazy securities fraud, which is what we're talking about here, they actually hire a team of economists to prove what would have happened if they had or had not done that thing. And we use a bunch of advanced models to pretty much tell the court, if they merge, this is how much prices are going to go up. If this company did not commit fraud, this is what they actually would have made money-wise if they hadn't committed fraud. And that difference is what they'll owe back to people, plus an additional penalty fee. And so they bring in these economists to help regulate the economy. And so that was the work I was doing for a long time. From there, I got my MBA over in the UK at Oxford, and I focused on finance and data analytics. And then from there, I ran some independent consulting. I sourced my own contracts for a number of years in strategy and management consulting. Then I transitioned into marketing, where I was the director of marketing and strategy analytics for a company in the Boston Seaport. And now most recently, I am the head of data governance for North America and the European Union for Wayfair. So I'm pretty much in charge of all of the information we have flowing in and out of our service and operations wing worldwide for the company. And so it's a very fun work. It's been a very fun path. And I will have some room at the end of this presentation just to have any Q&A about any questions you may have, not on Wayfair specifically, but around our industry or around any advice that I can give. So that being said, let's jump right in. So our case today, so like I said, it's going to be a guided discussion. I want us all to really have a dialogue here. So I really encourage people's participation. The more you participate, the more of a meaningful discussion this will be. And this is really just designed to, again, explore the ways that we think about solving these problems. Because we could go into the heavy technical things, but at the end of the day, it doesn't really mean anything if you do some crazy, polynomial regression and you don't even do it in the right direction or try to solve the right thing. And so I want to make sure that we have the right frame of thinking, and then we can talk more technical things as we go through this discussion. So as we go through, please bear the following 3 things in mind. The first, come with an open mind, be prepared to think outside the box. Secondly, I just touched on this, just be sure that you can think openly about these problems and that you focus on your thought process more than actually getting the answer right. And then lastly, there's no wrong answers. This is an open discussion. Just make sure that what you do is logically sound. And if you're not sure if it's logically sound, if you want to volunteer an idea, I'm fully expecting people to say some stuff where we might have to change course or correct a little bit. And that's good. That's good discussion because it tells us what not to do. So I want people to please be open, even if you're not quite sure what the answer is. And we can just have a very fluid conversation, which will be great. So here's our case. You are an analyst for this consulting firm, and this comes across your desk. Someone says, hey, Greenleaf, they're a nationally recognized car manufacturer. They focus exclusively on electric and hybrid vehicle production. So they're a green energy company. They focus on automotive sales, similar to Tesla. Greenleaf is being investigated by the Department of Justice on allegations that it published a series of press releases. So just so you guys are aware, a lot of companies every month or quarter, they'll issue a press release, which is very carefully prepared by their staff. And the press releases pretty much say how the company's been doing financially and what they plan to do, from both a strategic concept, like maybe rolling out new production plants in different parts of the world, or making a new product, to what they expect their earnings to be. And so they pretty much sent out a series of press releases over the course of the year. And these press releases misrepresented the value of their upcoming car model. And this could be anything. Maybe they said that it was going to fly, but more realistically, maybe they said there was some crazy cool new battery that they were developing. Maybe there was some awesome new feature, but those features didn't end up being as efficient as they were supposed to be. Or maybe they said we expect to sell, $2 billion worth of cars, and they only sold 500 million. That's less than half. And so they sent out all these press releases that got investors excited. And so these investors bought more and more of their stock. And what happened was their stock went higher than it should have gone because the press releases weren't accurate. And all of their executives who are compensated through stock all of a sudden became filthy rich. And these executives happen to be the same people who wrote those press releases. So the Department of Justice is investigating them, and they are pretty confident that they committed fraud. And now they've asked us if we can check to see if these press releases did in fact artificially inflate the value of their stock, if it went higher than it should have gone. And so that's the only question we're being asked. And aside from that, we just have a contact with Greenleaf, the Greenleaf's lawyer, who is legally obligated to give us as much information as they can. They can't admit that anything bad was done, but they can give us any documents we're asking for, any emails that were sent. And aside from that, we also have access to public stock market information to see what the price of their stock was, to see what maybe comparative companies or indexes, how those are performing. So we have some publicly available stock market data, and then we have access to their lawyers who are legally obligated, and this is enforced by the court. So if they try to hold anything back, they will get caught. It's actually a very good process. These lawyers have to give us any documents that we ask for. So we have to figure out if these press releases actually did increase their value of their stock more than it should have gone. So we have three assumptions here. The first is that it was three separate press releases that were published by Greenleaf. These are the big ones that are being called into question, and these are going to serve as the basis of our analysis. The second assumption is that we don't have access to any internal conversations that took place at Greenleaf. So, we can get these documentations, we can get like basic emails and stuff, but we don't have recordings of discussions. We don't have an email where someone says, let's lie and make a lot of money. It's not going to be that easy. They protect themselves. And a lot of executives are careful what they write because it could implicate them. And so, folks don't, they're very cautious of what they write in emails. And then lastly, our team, as I mentioned before, we're also able to get information from public records, right? So stock market data, i.e. capital markets data, any tax filings that the company made, and just any information on their website. We can look at the press releases, we can, investigate whatever we need to that's publicly available. So that being said, before I jump into anything, are there any questions about the assignment or any questions about what we're trying to solve for? Yes, Marco.
With this kind of situation where you're dealing with things that are kind of like vague, like did this have an effect on a market which is completely would you approach it from like a statistical economic incentive? Like what kind of like lens would you use to tackle this kind of problem?
Yeah, that's a great question. It's typically always a combination of both. So a part of it is getting a qualitative and subjective context, which is just human, right? There's no absolute truth that we're going to get in a forensic analysis, but we can look at indicators, right? So there's the contextual aspect of understanding maybe why these press releases now of any other time since the company's been around came out, right? Maybe, and this is all stuff that I can have answers for you on that's not to this level of detail in this deck, but to give an example for the way we think about these things, maybe they just got a brand new CEO, right? Or maybe they have a CEO who's been there for 15 years and he's on his way out and wants to make a little payout, right? Maybe the board of directors was just fully replaced with a new board of directors and these people want a little bit of extra cash. Anyone who's tied to their equity, that's the contextual aspect, that's the subjective aspect, and that's where we have to find motive. But then on the other end of things, yes, we will absolutely use a statistically rigorous process. And the thing with statistics, as we all know, is by its very definition, it's never going to be 100% accurate, right? So it's not accounting. So that means that, rather than trying to get the exact answer, we just want a reliable adjusted R-squared, or we want a reliable outcome that is statistically sound, and more importantly, statistically sound not just to ourselves, but to 9 out of 10 statisticians out there. And the way they prove that is the way this process works formally is we actually write a report, which can be anywhere from 50 to 700 pages. And yes, I've written both, and it's extremely frustrating with the long ones, but half of that report is giving context for why you're doing what you're doing and explaining your assumptions and your process from a legal and just logical perspective. And the second half is talking about your statistical model. And once you have your model in place, what actually happens is the court hires another economist from outside. Usually it's a Nobel laureate, no joke, I've worked with a few of them, or it's like a tenured department head of like an Ivy League school. They pay them very well to do this. and they'll have a Stanford PhD economist come out who's 60 years old and been doing this for 40 years. And, he'll come out and he'll actually go through our work and try to replicate it and try to do what we did with him and a small research team. And if he can replicate it, or if he can get very close to replication, almost like a peer review paper, then it's accepted by the court. So we can't just fabricate something. We actually have to have a rigid context, and then we have to create a statistical model, but it has to be so reliable that someone else can come in and say, yeah, it has my stamp of approval. It makes sense. Does that make sense?
Yeah, I didn't know that at least these processes would be so like A, so lengthy, or B, so heavily scrutinized. But I do get that when you have major companies at play, you might want to double check.
Yeah, and that's a good point, Marco. The main reason is too because one, the impact can be huge because we set precedent. If a company, from a legal perspective, if a company did this and say made $20 million, it's not a big deal, right? When there's like $300 billion companies out there. But if we don't do it right here, the same rule applies to Google, to Facebook. And so if they start doing it and they get away with it here, the smaller company, then Facebook and Google can do it and rob people blind with $100 billion profit or something like that, because we set a precedent that it was okay. And the second reason is just because most of the time it's not $50 million companies. I've been involved in multiple like multi-billion dollar instances where, yeah, like that money can disappear. And so it's usually no small sum. For that reason, it's very, very drawn out, just because there's a long review process and there's a very careful set of eyes on it. But yeah, it's fascinating. And it's a whole part of the world that people don't even realize exists, economic regulation. Cool. All right. Any other questions? Okay. All right. So we'll jump right in. So the first thing I want to show you guys is the value of Greenleaf's stock. Okay. And so this is over the course of a couple of years. And as you can see here, their stock, it varied here and there, but it didn't go crazy before each press release came out. You can see here, at the beginning of 2018, maybe it, went from $55 to $70 and maybe fluctuated around there, started going down. And then all of a sudden the press release comes out and boom, it spiked to about $80 and it stayed there. Even if this press release and this press release didn't come out, it would have just permanently been stuck at $80 or so. And then it would have just continued growing from there. Its floor had been raised. And we see that happen 2 more times with the second press release. And over a very long period of time, we saw their stock was very stable and continued at essentially double the value it was. And then here, the third press release, this one actually spiked it up substantially. And all of a sudden, we're seeing over the course of a year, a stock that for the most part seems to be very steady, very relatively flat when you talk about just the average, across a period of time, only seemed to spike up when these press releases were brought out. And once they were published, it never went down, which tells us that some facts were released or, alleged lies that these companies were trying to tell people that permanently increased its value in the stock market. And you can almost look at this line as not just the value of the company, but the paychecks of their executives, which are, about 90% stock. And so all of a sudden, this executive maybe has, 10,000 shares of this stock at $550. Maybe all of a sudden that just jumped to $120 per share over the course of a year. And so this is where we started seeing a little bit of suspicious activity. Once the faults in these products started being released, and we saw that these releases weren't always completely accurate. So I'll stop there in case there are any questions. Okay. So next, I'm going to talk about some of the available data that we have, right? So one thing that we did ask for from the lawyers that we're working with for Greenleaf was stock trading records, because basically if you work for a company that offers you stock, they'll work with a bank like Fidelity or Citibank or, anyone like that to actually release those stocks, keep a record of it, say who sold what and when. And so we were able to work with their lawyers and get that information from the bank. And so this is just a sample, obviously. This isn't the full data set. There are, billions of rows of millions of trades happening and millions of shares going from all of their staff. But what we do have is we're actually able to whittle down just the stock that was sold by their executives, bought or sold over the course of this whole 2-year period. And so we're able to access their trading history. And basically with the data that we have available, it's the date and time of each transaction that these executives made. And if you see tens of millions of trades there, it doesn't mean these people are clicking trade every time, tens of millions of times. It means maybe they want to sell, maybe 50,000 shares here and then buy 20,000 shares there, sell 50. And so each share that goes through is a single trade. So 50,000 shares is 50,000 trades. So just imagine this is a very large data set that tells us every stock going out and in for these executives over that period of time. We have the unique order ID for each trade. We have the QSIP, which is just a code used by stock exchanges to be a unique identifier. So this QSIP is going to be the same throughout the entire data set. It's just the Greenleaf QSIP. It indicates Greenleaf stock. We have the asking price, which is what they tried to sell it at, and the settle price, which is what it actually sold at. This is very common in stock trading, where maybe you click sell now and it's at $100, and maybe by the time that electronic message goes to the bank and comes back and it makes the trade, maybe it went to $100.02. It's usually very small. And then the exchange. And because this is Greenleaf, it's all traded on the same exchange, the New York Stock Exchange, because every stock just belongs to one stock exchange. So this is New York. And so this is basically just to let you guys know at a high level, we have the information on the trades that they made in detail. But this isn't enough, right? Because now we're saying, okay, what are we trying to solve for, right? We're trying to solve for how much money they would have made if the stock price hadn't gone up, right? If they hadn't artificially blown it up. And here we have the stock data, but the stock price is going to go up in this because the value went up. So, we're not really going to see any evidence of what it could have been, right? We're just going to see what it was with this information. So this is a bit of a tricky question. And I'm curious if folks have any thoughts on maybe what else we could look at that might be correlated to the value of their stock historically, or what might be something that we could compare their stock price movements against over a long period of time, say 5 or 6 years, right? Is there anything that you guys could think about that maybe we could, draw on that might be publicly available or available in their own records that we could maybe start to look at, what could move side by side with their stocks here, to give us an idea of maybe once they started going a little too much over the top? All right, and I'm going to give you a couple of ideas. Marco.
Don't usually whenever they release, whenever there's a major stock acquisition, they have to release a form. I forget what the form's called, but can you track, compare it to their specific holdings to see how much exactly they'd make?
Yeah, so that's an excellent question. So that would be in relation to that's an excellent suggestion, actually. So that would be in relation to their book value. And that is one thing that we could absolutely look at. So basically the way a book value works, just so that everyone's aware here, is book value is essentially the total value of a company based on its net assets. So a company has assets like equipment, people, intellectual property, and it also has liabilities like debt and things like that. And so once you subtract the debt from the assets, you get what's left over. And that is typically a company's sort of net asset. It's net worth, right? And so at a present date and time. And so then you look at how many shares they have outstanding, like how many shares are in the market, and you divide the number of assets that they have by the number of shares. and you end up getting sort of a book value, which tells you, the value of the company on a per share basis according to their books, according to their accounting records. And book value is always lower than the stock market price, because stock market price is set by investors, not by the company. And that price typically bakes in the future value of the stock, which is why it can spike and move around. People have expectations that might increase or decrease the value of something. Similar, honestly, to what's happening, right now, unfortunately, in Eastern Europe, where Russian stocks were doing okay, and then while maybe the book value of some of these companies in Russia hasn't changed over the past few days, the stock market value plummeted because investors are seeing how these companies can't make bank transactions anymore. Their supply chains are restricted and their future value has fallen. And so it's very similar to what Marco brought up. So Marco, that's a very good point. That's a great one. Does anyone else have any other thoughts on things that we could look at? All right, I'm actually going to give a clue here. So for the analysis that we did for this particular case, we did not look at book value, but that was an excellent suggestion. And that is something that we sometimes do look at depending on the nature of the case, because book value is a good basis for us to determine sort of the true worth of a company, right? And it's used very heavily in valuation. But for this particular case, we were actually looking at some comparable stocks, right? So we were taking a look at other competitors that Greenleaf was competing against, right? And we were trying to see if, maybe over time, we had some competitor stock values that were very highly correlated to each other. So for example, I can tell you guys, there are two stocks. This is a very random example and it doesn't relate to here, but for the concept, there are two stocks, Palo Alto Networks and CrowdStrike, if you guys ever heard of either of those, and they do cybersecurity. And so they're very large multi-billion-dollar companies, and they essentially provide cybersecurity equipment, software, and consultations for large companies. And they are both direct competitors with each other, but they're both relatively equal in size in terms of the amount of money they make, market capitalization, size of their staff. They have similar debt to asset ratios. Like, they're relatively comparable companies, and they're both making the same thing. And so their stock, each stock of them actually moves pretty closely to each other over time. So they're both relatively highly correlated, like a 0.7, 0.78 like correlation, which is very strong. And so what we did was we actually checked the stock market to see if there was anything that Greenleaf was competing against that could be highly correlated with them. And the way we thought about this was, there's no way to ask that question, right? You don't just type into Bloomberg or Yahoo Finance and say, what's highly correlated with Greenleaf? We thought about their competitors. We went through it, and a lot of their competitors were not comparable. They either weren't as big as Greenleaf, or they were doing slightly different stuff, or maybe they were purely electric and much smaller rather than electric and hybrid and much bigger. Maybe they didn't have European clients and Greenleaf did, and so we couldn't find a one-to-one. But what we were able to find actually were indexes. And so these were correlated. And just so that people understand what an index is, so think of it like the S&P 500, if you guys have ever heard of that or worked with that. There's individual stocks, but then, like an exchange traded fund or a mutual fund, there's another type of financial product that actually consists of like 20, 50, 100, 1,000 different companies that are all under a certain category. It could be by how big they are, by the industry they're in, but it's a group of companies all pooled together into a fund. So let's say like I'm Vanguard and I have $100 billion to sit on, must be nice. I would put that money into, let's say, arbitrarily 100 different companies. And then I look at how the total value of that $100 billion moves over time. And that's an index. It moves according to how everything in that basket moves. So it's essentially a weighted, like it's essentially a weighted sum, like a weighted product of all these companies' movements together. and they have them for clean energy companies. And we were able to find these two, which are actual indexes, ICLN and QCLN, which we saw moved over the long term, over 5 years, long before this fraud happened. We actually saw that it was very highly correlated to Greenleaf, which is very exciting. So we are essentially now seeing stuff that over the past 5 years have moved historically in the same way that this company has been, which might give us a little bit of indication into, if things had continued the way they should have gone without these press releases, what would have happened? Maybe we can use them to approximate the value of Greenleaf over the most recent couple of years when the press releases came out, when things changed. So this is something I'll pause on. I know that I'm giving a lot of financial context as well for folks. So I just want to take a moment in case people have any questions about sort of what we've covered so far, where we plan to take this next, or if I can answer any questions about just kind of finance and stock market information and things like that. Cool. All right, and feel free to raise a hand as we go through. So I guess now knowing what we know, which questions should we be asking to better understand how these press releases contributed to the spike in Greenleaf stock value that we're seeing, right? So I think we've already covered a lot of this, so I don't think we need to belabor this point. The main questions we're asking, though, are, and actually before I go to answer it, I'd actually like to open it up to you guys in case people have any additional thoughts. Knowing what we know, we saw when the press releases were issued, we saw how the spikes clearly happened. We saw the information that we have on Greenleaf's trading. We saw the index information that we have. So I'm curious now if anyone here has any additional thoughts for maybe extra information we could ask for, or any ideas for maybe how we can pull this data together into a model that might be able to tell us what Greenleaf would have been, what the value of Greenleaf stock would have been if they hadn't tampered with it. All right, and I'm happy to call on people too, but I'd rather not, but I definitely want to get some folks' thoughts here. Yes, Marco, thanks for jumping in, Marco.
I'm trying my best. Would you just start like pulling RMP values, or is there anything else that we kind of need?
So yeah, you would start pulling some values, and there's a lot of background work that can go into this, like in terms of what you had mentioned, things like their accounting forms and their filings. But I think now that you mentioned pulling some values, and this is a question not just for you, but for the whole room, is there a certain model or a certain maybe statistical approach that we can take now that we have, I'm happy to say we have, like, obviously there's a very simplified version of this case, but now that we have the stock market value of Greenleaf and we have the value of these two indexes, is there any sort of statistical model that we can put together to actually arrive at a number for what Greenleaf stock value might have been worth if they hadn't issued their press releases? And it's not a complicated one, I'll tell you that. Low-hanging fruit. All right, Emily, I'm going to call on you. Sorry to put you on the spot.
Sorry, I'm walking right now, but is it something like is it something like a kind of like a linear regression? Or
yeah, honestly, that's a correct answer. Yeah, so what we do is we start with a linear regression model. So we conduct an event study, and the linear regression model, it doesn't start with a linear, like it starts with linear regression, but it doesn't end with one. Like we just try to begin with an initial regression model and then eventually add layers of complication to complicate the model a bit more. But that's exactly what we do. It's, you think it would be more complicated than that, but the cool thing about stock market data is it's almost always clean. It's like the only data I have ever encountered in my entire career, no joke, that is almost perfectly clean every time, right? Like all you have to do is maybe merge from different sources and a few different things, but it's always the same, like 10 to 20 columns of information. You can organize on like unique identifiers and keys. Like it's very, very straightforward. And so because of that, there's usually no blackouts or anything. Like they legally have to tell you when a trade occurred every day and every second of every day and every millisecond of every day. So there's no blackouts or weird things you have to accommodate. It's really just holiday blackouts, maybe for different exchanges in different parts of the world where they celebrate Thanksgiving in the US, maybe Boxing Day in Canada. But aside from that, it's pretty clean. So that's exactly it. We conduct what's called an event study. So an event study is, this is going to be very tautological, but it studies events, right? So what it does is it sets out to understand how a series of events have impacted a specific outcome. Pardon my typo with and specific, that drives me crazy in that slide, but yeah, these are typically done by running a historical regression of the price of Greenleaf stock. We removed the days when the press releases were published so that there's no like single day spike that'll be factored into the regression where maybe it jumps like 20% in a day. And we run it against the S&P 500 or some industry specific indexes. And we have those indexes here. And basically what this does is this is kind of the cool way how we do it. And I almost wish I had a visual to show you. They're kind of hard to visualize, but the way it works is right now we're investigating what happened from 2018 to 2019, right? So let's say beginning of 2018 to like early 2019, that's like when the stock market, when the stock value increased. So what we actually do is we create a regression and we regress against price of Greenleaf, price of the two indexes. And what we do is we'll actually start like 5 years back and we'll run so many regressions. Like we will start with linear and we'll make it, I don't know, the first 3.5 years of data and try to forecast the next year and a half, right? That like, so maybe from like 2013 to like, we'll use like 2013 to 2017 to forecast 2018, 2019 and see what Greenleaf's price would have been, right? We will do a similar version, right? Where maybe we, instead of linear, we start adding some polynomials, right? Like maybe we start making it nonlinear or some quadratics, who knows, right? Like I'm both the same, I guess, but you know what I'm getting at. Or, you know, what we can also do, and one of the other approaches is we'll actually stagger it. We'll keep it a 12-month rolling historical data that we feed into the model and just move it up a day and do that like 1,000 times and see like how far out we can forecast and how accurate it is. Look at the adjusted R-squared, look at if the coefficients make sense. And we'll run like, you know, you can loop it in code, right? And so like you can just run like 500 or 1,000 of these and then just automatically just filter out anything that has like a, you know, like a adjusted R-squared below like say 0.85, right? Or anything that might, you know, not like, just not have statistical significance for whatever reason, or might, you know, not hit like the t-test that we want it to hit, like when we're doing like some sort of checks for things. And you end up you just have all these filters automatically in place in your code. So modeling it maybe takes half a day, and then running it takes, depending on the size of the data set, anywhere from, I don't know, 10 seconds to maybe 2 hours, depending on the size of the data set. And just like that, you have all of your regressions and what's going into them. From there, you have the final output. Maybe you've whittled it down to like 30 regressions that have the most reliable outcomes. Maybe we rotate in a couple extra indexes, maybe S&P 500, whatever it is. And we just try to balance out that qualitative, quantitative thing that Marco had brought up earlier, where we're trying to look for statistical reliance, but also try to find some reasonable subjective analysis for causality as well, right? So like we're trying to find, okay, we have these maybe 30 regressions left over out of like the 1,000 we ran that make the most sense. And maybe the court, we just know that the court wants to see the S&P 500, right? Because these are judges and judges aren't economists or statisticians. So maybe they just trust it better when the S&P is in there. Cool. Well, of these 30, 10 had the S&P. So now let's look at these 10 with the S&P. You know, maybe these didn't include certain holidays and these did, and remove those. And we eventually end up getting, you know, pretty much carbon copies of the same thing. Like they're very similar to each other, very similar outcomes, very similar everything. Maybe the final value of their stock over that period of time is within like $2 or $3 of each other. And at that point, it just comes down to making a call on what you think the court is most likely to accept. And you've just gone from a variability of $50 to $120 to a variability of maybe like, standard deviation of 50 cents to $1. And it's just a matter of making a call on which one you think the court is going to accept. And then once you do that, you put it in your analysis and you already have your assumptions in place. You just update the models to reflect what's there and you share it with the court. So the data is combined. It's put through this regression analysis. And we end up being able to tell what the price would have been if they hadn't issued these press releases using this regression model. And we use that difference. So maybe the price through 2019 should have been around $80. And it was, let's just say for argument's sake, it was 50, went to 120 for argument's sake. So that was a $70 per share gain. And maybe we realize it should have been just $80, like a $30 per share gain, which means they made 40 extra bucks per share that shouldn't have been there. So the court will multiply that $40 times the number of shares they sold the profit from, let's say 1 million, and that's going to turn into $40 million that they gained unjustly. And that means what they'll owe is typically, according to the court, 3 times that amount. It's called treble damages. It's very common. So they will owe $120 million plus legal fees, plus maybe if they lied to the court, maybe an additional 100 million back to anyone they defrauded, pay it to the Department of Justice to go into the government and help supplement, what taxes pay for. If there were specific investors, like some of their high profile investors and venture capitalists who may have supported them over time, who got defrauded and weren't aware of it and have to deal with bad reputations now because they were involved in a bad company that they didn't know was bad, they get some of that money. And it's pretty much just making sure that the folks who gave them money in earnest cash to support them are being rewarded in the right way. And so we use that to determine the amount they owe, and then that amount is distributed to whoever is most affected. And this helps keep the economy regulated, because when things like this happen, people don't want to get caught doing it, so they try not to do it. Similar to police, right? Like, it's not always effective, but it does keep things relatively in order, particularly if someone is found to be guilty of something and we can prove it statistically. So they were ordered to pay triple damages to their shareholders. What ended up happening? It ended up being, for this particular case, the reality of it, if I remember correctly, obviously the company wasn't called Greenleaf, but it was about $280 million, if I remember, that they ended up owing people. So I know it's a bit of a lengthy discussion, but we're at the end of our lecture. We have 10 minutes left. I'm sure some folks are processing, so I am happy to sit back and just take some time to answer any questions folks might have about the case, to just be here as a resource. But yeah, I'm happy to just comment on anything. The model that we worked on in more detail, the process in more detail, my experience working litigation consulting, or just generally how to approach these types of problems when you don't always have perfect data and you have to almost create something out of nothing. All right.
Patrick, I was going to ask a real quick question. How long did this entire process take? How long were you working on this case?
Yeah, sure. So this case was, I want to say, about 5 months. And I would say it was myself. I'm doing a count right now because I remember the actual case. It was about 6 people involved in it. And I would say it took up maybe, in total, maybe 80 to 100 hours a week across all of us, like in total. So maybe I put in 20 hours, someone else put in 50 hours, but it came out to about 100 hours a week across 6 people for 5 months. And a lot of these conversations are, the actual analysis is very quick, as we all know. It's more so getting that context and having these conversations with their lawyers, having our research be conducted. I mean, anyone who's programmed any machine learning or made any basic data visualization, you just pretty much at this point, we're in an age where you can just click and run and then like it's done, right? Like if you create a random forest, so you create like a, natural language processing algorithm, that takes 2 to 10 minutes, right? But then the question is it correct, right? Like then you have to start adjusting your alpha. Then you have to start jumping in and like changing your assumptions and the data that you put in, and like, you know, your like filters and things like that, and, you know, adding new sources and, you know, tweaking things and running tests. And that's what takes a lot of time. And so that's what took a lot of the time with this. It wasn't actually writing this regression and pumping it out. It was all of the planning, the interviews, the conversations, the context, and determining the best course of action. Like, you know, Marco gave a great example of book value. Why didn't we go with that example? There are certain reasons from a legal standpoint, from a statistical standpoint, that we wanted to make sure were addressed. And so we had to find the right approach and then tweak everything, run it, and then run it 100 more times until we hit the right level of accuracy.
Got it. Thank you.
Of course. All right. Yes. Question.
Yeah. Hi, Pat. Thank you for having this session. So
course.
can I ask a question about the interview process at Wayfair, because I'm currently in the process of this interview.
Yeah, sure. I can speak to that briefly.
Yeah. Just I'm currently actually like waiting for the final round of it. Like I applied for the technical analyst in Wayfair, and I think it's under the algorithm and analytics team. So like, what would the could you go over the process of the final interview, like the overview of it?
Sure.
Mhm.
Yeah, I'm not sure if I can speak directly to it just because it varies from team to team and department to department. But usually in general, what you'd be looking for is if you've already completed your case interview, then all that's going to be required is most likely a final discussion. Probably, again, this is just not, I'm not sure exactly how the specific team you're interviewing would interview you, but in general, if you've already given your case, it would just be a matter of sitting down and almost just having a comfort level conversation, where if you've already presented your case, you've already gone through your frame of thinking, and they're still pushing you forward, then the final round is really just almost an airplane test, which is what they say in the consulting world, which basically means if you're going to be working with this person all the time, like, could you sit with them on your way to the airport? Could you be on a flight with them? And so it's more of like a cultural fit, where it's no knock on, the candidate if they go through or not. It's more so if like just that particular group of people feels like they would work well with you and the way you think and answer problems.
Gotcha. Because I've already did the like case discussion in the first round, so I'm not sure if they still doing the case discussion like for the final round, or they do provide more of the behavioral question, something like that, because I never did the behavioral question in the first round.
Yeah, then it'll probably be behavioral, honestly. I mean, don't take my word on that, but if they've already given you a case, they won't give you another case. It'll probably be either a behavioral conversation, or in the very, very worst, they might give you like an off the cuff, use the back of a napkin, small type of case where it's not really formal. It's just, how would you think about, similar to what we did here, just how would you think about this? And there's no right answer, but sort of see like the questions you ask and the way you ask them.
Gotcha. Thank you so much.
Of course. All right. And I know we have just a few minutes left, but are there any other questions folks might have? Yes, Marco.
Just from like a career standpoint, I've heard a lot about kind of data science as a path, software engineering, data engineering. Then there's consulting, business analyst, but I've never really there's not that much like guidance on kind of data governance as a practice.
Yeah.
So from your perspective, like kind of what roles or what both skills and roles should we be looking for if we do decide that this is an interesting path to take?
Sure. And do you mean data governance strictly, or do you mean like a certain area of data science?
Probably to do this kind of research where you're kind of aiding a team in doing more kind of statistical analysis to come to a kind of pseudo research conclusion.
Yeah. So this type of work, I would definitely just advise that you that you take some, I would say, business and economics courses, because that context is key. That's also, I would say, the best way to also just move up through your career, whatever you end up doing. I know there are a lot of folks who, maybe have a combined major in biochem, or business or econ here. And I would just say to continue to have that diversity, because data science in and of itself is useless, right? Like, it's useless without any context. If you're just running numbers all the time, I mean, anyone could, right? We need to know what problems we're solving for. And so the analyst won't always understand that full context. And so if you come into a field where, in my mind, for me, it was economics. So I wasn't trained in a specific industry, but I was trained almost just in general how things work and decision-making functions. And then I picked up industry-specific insights over my career. But a lot of folks will hope that they'll join a company and that company will teach them the particular areas of their business, which does happen, but not as much as it used to. I mean, it didn't happen for me, and that was 10 years ago, right? And so, like, these days, it's even like trickier. They'll give you training, but you won't learn the business. And so when you join, you're almost already kind of playing catch up. And so anything you can do, even if it's on your transcript, one or two courses, or even if you just read these days, if you just like read a couple of books or do some podcasts and can speak to that during an interview, that you understand how the business works, then you'll be able to do that sort of contextual research. You'll be given more responsibility. You won't just be asked to do certain analytical tasks, and you can put yourself much more quickly on a career to run these sort of, to your point, like almost semi-academic or quasi peer-reviewed types of scenarios, where you're not just being called on because you're good at stats. You're being called on because, more importantly, stats is just a hammer, but you also built the house, and you know how every part of it is built. You know which parts are weak, which parts are strong, and you don't just know how to drive a nail in. You know where to drive that nail in and why, and how often to check on it, if that makes sense.
Yeah, so I'll try to like make sure to pick an area and build my skill set around that area.
Yep, and it doesn't have to be picked now, but I would say that's why econ, I think, is a good, econ or business are good things to, again, it doesn't have to be a formal course, but good to explore, whether it be in a book or several podcasts, just like something to get you off the ground, or a free online course, because like for me, I still like am figuring stuff out always, right? Like, and I always will be, because everything's always changing. But for me, it's more about learning how things work in the broader sense. And econ taught me how to think that way. So everyone has their version of econ. Some folks, it's, English grammar, and they like the way things are structured and pieced apart. For some folks, it's political science. But if you're looking to get into industry, I would say econ or business over finance. Econ or business would be good to give you that context for why these decisions are being made. And that'll help you become a bit more of an owner for the work that you're doing statistically.
Okay. And just, sorry, I'm trying not to be too
Yeah.
pushy on the questions or anything.
No, of course. And if I'm not answering it, please push back.
No, but just as a follow-up, it's just like coincidental that I am going to like a business analyst position as a co-op, going into the fall.
Mhm.
But it's at a private equity firm, and I know that compared to like kind of the tech world, where it's like, can I have this consumer data, and it's all like tech driven. Often, like in finance, there's hierarchies, there's managers, there's restrictions. So how would do you have any advice or context about the different like bureaucratic processes that go in this research?
Sure. And just so that I make sure I'm answering the question correctly, do you mean in this research that I was explaining here in economic consulting, or do you mean in this research in general, just, as you're around your course as a business professional?
More just in general in this area of like data governance.
Yeah. So I think there is a lot of bureaucracy, and no matter which way you look at it, you won't have much control in the beginning. And that's why, like I mentioned, over time, like demonstrating that ownership. Like I myself, this is my first data governance role ever. I've always been involved in data governance. Like I've been a coder, a technician, a statistician, economist, like an engineer, like all of those things. But governance was always a component of my work, right? And so I found this cool opportunity here now where I work. And so now it's more pure governance. And I still do a lot of other stuff too, but governance is now the main part of my role. But just so you know, you don't have to stick on like point one and still finish on that same point 10 or 15 years later. Like you can always experiment and change, and employers actually prefer it if you experiment and change, and that'll help you navigate the bureaucracy. It's kind of weird. Like these days it's hard. You have to develop both a specialization, but still maintain that generalist knowledge. So for private equity, for example, first of all, congratulations. That's an excellent opportunity. So I didn't mention this in my background, but I also have a second, it's not a degree, but it's a certification from Oxford it's almost like a diploma. It's like a secondary thing in private equity and asset management. And it was a big area of interest in mine for a while. And I will say for PE, it does in the finance world, things are incredibly bureaucratic and political, which isn't always a bad thing. But I would just say there's a lot of instilling confidence in things that is like much more important in the area of finance than anything else. And that's not just giving confidence to your investors and your stakeholders, but also giving confidence to your boss, right? And making sure that that they know that you know what you're doing. And if you're coming in from like a business analyst standpoint, depending on your role, it'll depend on the firm. I'm sure you're with a great fund, but sometimes they'll put analysts a little bit more away from some of the like less analytical folks, the folks who are more focused on spreadsheet work and things like that. And they'll just view the spreadsheet guys as kind of the folks who will have some sort of harder drive to get up the ladder. And the analytical folks, they just will kind of assume that like, oh, they're happy here doing their analytics and it'll be a different career path for them. And the end of the day, it really comes down to making yourself stand out for what you're interested in. So get into those analytics, get heavy into it. And even though it's just like for a short period of time as a co-op, obviously this is a gateway for your career and you could always come back there and be rehired. So just make sure that you demonstrate not only a strong interest in what they're hiring you for, but also that you're understanding their business and why these things are being done, like why their portfolio consists of the companies that it does, what their investment thesis is, and why. Like why the IRR that they're trying to pursue is reasonable and what they're telling their shareholders. And like tie that all in to your work, right? Like, I mean, a gift is a gift, but it doesn't really mean much if it's not with a box wrapping and bow, right? Like it doesn't really feel like a gift. And so you want to make sure that you wrap up your work like a real gift to them. Like you have this other context and these other elements that make it cool and flashy and diverse. And then express interest that maybe there are some areas of the business that you want to pursue afterward. And whether or not it turns into an offer or not, you will get that additional context just based on working with their portfolio. So I don't know if that answers your question, but in general, I would just say the best way to navigate that bureaucracy is to give them the confidence they need beyond your existing role of where you want to be. So it's not just hitting all the marks for what you want to do, but also showing that you can flex out of it and think outside of your role as more of like a manager of the company. Start thinking about the mindset of the people you report to. Again, I'm not sure if that answered your question.
No, that very well did. It's a very different approach to like, at least from what I understand, like traditional like software engineering, where it's just kind of do the work and do the work exceptionally well. It seems that here the focus is more on like, being there for them and like having a good understanding.
No, and I will just say briefly for software engineering, with software, it's a little different because most software engineers work for software engineering companies, right? Most of the time, or like there's like a huge wing. But with data science, we don't have that luxury. I'm very proud to be a data scientist, and I hope you all are too. It's in my mind, the most fascinating aspect of just, this area of work that we do, like just the types of problems that we solve. And because of that, there are very few data science companies, right? Like that actually just make data science what they do. They pull in data scientists. So like Google isn't a data science company per se, but they'll pull in data scientists. Same with Wayfair, same with GM, same with Tesla. None of them are data science companies, as opposed to say like Microsoft, which is purely software. And So like we are actually a complementary tool. So it's very important, particularly for what we do, to know the business context, because in and of itself, we are never trained in it, because we'll probably be doing it for a million different companies throughout our careers that do very different things. So it's all about carving that path.
Well,
Cool.
thank you for kind of giving the guidance. And I know I asked a lot of questions, but it's very
No, it's good. I appreciate it. Awesome. All right, guys. I know we're over time, and I appreciate folks staying on. And I just want to thank you all for taking the time to, bear with me during this conversation. I hope this has been informative for all of you. I know I've been in the position that you guys are, and it's very exciting. So I'm looking forward to seeing where you guys all go to succeed. And I know some of you I haven't gotten a chance to speak too much with, but I will just say thank you again to all of you for just taking the time today.
Thank you, Patrick. Thank you for taking the time to come out today and to speak about these really interesting topics, to speak about your wealth, experience, and knowledge on these case studies, and kind of giving us something to think about. Really appreciate you taking the time to do that. Thank you, everybody, for coming to our meeting today. Sorry, we ran a little over. If you want to watch this again, we're going to be posting this on our YouTube. You're able to check that out. And please stay tuned for other events that we're going to be doing this semester. We'll update you on our mailing list and within our Slack. Patrick, thank you again so much. This really has been a lot of fun. Hopefully we can do a lecture series again in the future.
Anytime, just let me know.
All right, perfect. Thank you. Everybody, you have a wonderful night. Best of luck with the midterms.